benefits of infrastructure is its predictability. If you think about companies like utility companies, companies that are providing essential services, things that you and I both need. So these could be electricity transmission businesses, they could be water companies, wastewater management businesses. You and I both need it. And because you and I both need it, we're going to pay to use it. And so what happens is you have companies which have got strong, predictable cash flows. And these are often backed by regulation. In many parts of the world, regulation is often considered a way of kind of stemming or weakening profits. But in many ways, for utility companies or infrastructure companies, it means it gives them guidance on what they can earn, and they know how much they can then charge investors and clients. And actually what it does mean is that we, as investors in those companies, have a higher regard in terms of the predictability and safety of those returns in the future. So infrastructure is very attractive from a predictability perspective, predictability of cash flows, and that leads to predictability more of dividends in the future, which is great for us as investors. The second thing is infrastructure companies grow. If you think about toll roads, seaports, airports, they're constantly growing their network, growing their terminals, growing the amount of roads. If you think about pipelines, they're developing more pipelines, taking resources from A to B. And in that growth phase, which is often linked to population growth, urbanization, the growth of cities, what you have is asset-based growth. That's the key driver of infrastructure companies growing, asset-based growth. And as they grow, they take more cash flows, and as they take more cash flows, they pay out more as well. So for an income portfolio like ours, that's a very attractive feature. So what makes Rare Infrastructure special? First of all, they are a purely dedicated infrastructure manager. All they do, since they were created in 2006 by two managers who had worked in the infrastructure industry themselves, all they've done since 2006 is build dedicated infrastructure funds from listed securities, i.e. listed stocks on listed exchanges around the world, which means that what they have done is build a dedicated investment process to finding companies which meet their criteria. RARE actually stands for risk-adjusted return to equity. So it's not just about what the returns of those companies are, it's actually how much risk is associated with those companies. And only by having the balance between return and risk can you truly understand the value of that company and how you compare that company to others in the world. And then when you're building a portfolio, balancing those risks in a profitable, long-term portfolio full of predictable cash flows, predictable returns, which means something that's an attractive defensive growth concept for our investors. If you think about the Legg Rare Global Infrastructure Fund, this fund is designed to deliver a 5% net income through a cycle. And the only way to do that is by finding and seeking the right types of companies that meet that criteria over time. So predictability of returns, predictability of cash flows, predictability of dividends is one of the key things that we look for. And Rare Infrastructure's whole process is about finding those companies wherever they are in the world. What makes them special is they've got 13 investment professionals, which makes them one of the largest listed teams in the world, dedicated only to finding those companies. Based in Sydney, Australia, since 2006, and they run over $4 billion of assets today. So when I think about income and a portfolio delivering a healthy income, actually I think it's a really attractive mechanism to gain safety in a portfolio over time. If you think about it, what does late cycle mean? It means that you'll find potentially the market continue to rise, but with that, bouts of volatility, higher levels of volatility, and at times significant drawdowns, the market going into shock or correction, like we saw in October and December 2018 when the market fell dramatically. In that phase, you want to have companies which have a more defensive feature, more posture. And if you think about what infrastructure companies are, by nature they're more defensive, they're offering an essential service, most of them, so therefore they're not just going to go out of business tomorrow because people kind of generally need them if they're well run. And secondly, by offering the income, when markets are going down, these companies are less liable to be sold immediately because investors are still picking something up by owning those stocks. So in a late cycle, the income acts as a cushion. It acts as a cushion because it supplements your total return. But secondly, They're less liable to be sold as stocks and when the market's in free fall, because people want to own defensive stocks during that phase. So in periods like that, these can be very attractive. And maybe if we've already seen some of that late cycle, if you think about Q4, quarter 4, 2018, when the UK and the global stock markets fell about 10%, our fund was pretty much flat. That's an excellent performance in a period of significant drawdown. So we think this defensive growth aspect of our portfolio is very fitting for a late cycle environment, and the income is a key component of that. The infrastructure landscape is significant. If I think about the income universe that we have, we've got about 160 companies around the world that look and feel like a good quality infrastructure company that we've done our work on and pay a nice dividend. That's too many. We actually build our portfolios of roughly 30 to 40 stocks. And if you think about where we see opportunities today, we're starting to see a few more opportunities in emerging markets, countries within Latin America and stock markets within China. We're seeing companies come back because their stock market prices have fallen a little bit during some of the turbulence. And that's been attractive. For example, we've recently invested in a Chilean water company, which we've owned previously, which is a very attractive, healthy water business in Chile. And that is something that we like. We like predictable companies which provide essential services with a healthy dividend. We also see a few more opportunities in the US. With bond yields falling, you also are starting to see that certain companies have got attractive upside valuations. So our whole process is all about trying to find companies that balance risk versus return, finding that excess return between the two. And what we're finding is very attractive companies in the US as the US bond yields have come down. So again, we'll selectively invest where we see the opportunity set. But very much our portfolio is built organically bottom up. We are predominantly stock pickers. Our asset allocation decisions, our macro decisions are more modest relative to that whole idea of finding the companies with the best excess returns around the world and then building them into a smart portfolio that can deliver income.